Welcome to the Basics of Accounting, Part 2. By the end of this module, you will be able to identify basic financial terms and record and report financial transactions, analyze business and financial decisions using financial statements, create budgets, compare them with actual expenses, and manage working capital effectively. There are mainly three key financial statements that any organization uses to record its business transactions: balance sheet, profit and loss statement, cash flow statement. The balance sheet is a financial statement that reports a company's assets, liabilities, and shareholders' equity. It provides a snapshot of the company's finances, what it owns and owes, as of the publication date. The balance sheet follows a rule that makes the assets equal to the sum of liabilities and shareholders' equity. The profit and loss statement shows a summary of income, expenses, and costs that occurred over a fixed period, usually 3 months or a financial year. These records indicate whether a company can make a profit by increasing its income, reducing expenses, or both. The cash flow statement shows a summary of the cash inflows and outflows in a company, along with their corresponding items. It indicates how well the company manages its cash, meaning how effectively it is earning cash to pay off its debts and cover its everyday expenses. The main difference between accrual and cash basis accounting is the timing when revenue and expenses are recognized. The cash method provides immediate recognition of revenue and expenses, while the accrual method focuses on expected revenue and expenses. Accrual accounting. It records revenue and expenses when the transaction occurs, but before the cash is received or paid. It provides a more accurate view of a company's health by including accounts payable and receivable. The accrual method is more commonly used by larger companies, especially publicly traded ones, because it smooths earnings over time. Cash basis accounting. Cash basis accounting records revenue and expenses when the actual cash is received or paid in relation to the transactions. The cash basis method is typically used by sole proprietors and small businesses. In a large business, there can be hundreds, thousands, or even millions of transactions daily. Maintaining and updating the balance sheet, P&L statement, and cash flow statement after each transaction is a cumbersome process. Missing even a single transaction can have serious consequences, potentially causing imbalances in the balance sheet and affecting the overall financial health of the business. Accountants worldwide solve this problem of ledger transactions through the double entry system. A general journal is simply a book where each transaction made by the business is recorded in chronological order. It is a collection of all the transactions that a business is involved in. A real account is a type of ledger that is not closed at the end of an accounting period. Instead, it remains open and continues into the next period. Real accounts are used to track assets, liabilities, and equity. A ledger is a record of all transactions that take place in a business. It is divided into three types: sales ledger, purchase ledger, general ledger. The general ledger can be further divided into nominal ledger, provides information about expenses, income, depreciation, insurance, etc. Private ledger provides private information such as salaries, wages, capital, etc. Now let's understand about financial reporting. A balance sheet presents a summary of the company's assets, liabilities, and shareholders' equity at a specific point in time. It is one of the fundamental documents that make up a company's financial statements. A balance sheet contains the following parts: assets, liabilities, equity, net worth, profit and loss statement. There are two kinds of assets: current assets, items that are due within the upcoming financial year by 31st March. These assets are expected to be either sold, converted into cash, or used within 1 year. Examples: cash, inventory, accounts receivable, loans, and advances expected to be returned by 31st March. Non-current assets. Items due after the upcoming financial year. These are assets that are used for long periods and have a lifespan of more than 1 year. Examples: tangible assets. These include machinery, buildings, land, furniture, and equipment. All these are collectively referred to as PP&E, property, plant, and equipment. Intangible assets. These include patents, trademarks, copyrights, goodwill, brand identity, etc. Liabilities are also of two types. Current liabilities. These are liabilities that are due to be paid within 1 year. Examples: accounts payable. These are expenses that have been incurred but not yet paid: salaries, payments to vendors and suppliers, short-term loans, taxes to be paid within the financial year. Non-current liabilities. These are liabilities that are due to be paid after 1 year. Examples: long-term loans, long-term leases. Equity. This represents the total ownership interest, equity, of all shareholders in a specific business. It reflects the business's net worth, which is the difference between total assets and total liabilities. A shareholder's equity is of two types: share capital and equity reserves and surplus, R&S. Share capital. This is the amount raised by issuing shares in exchange for cash, and it is typically recorded as the par value or nominal value of the stock. Equity reserves and surplus, R&S. This is the amount accumulated by a company over time from its profits and other sources that has not been distributed to shareholders as dividends. It is recorded under the shareholders' equity section of the balance sheet. R&S is calculated as total assets minus total liabilities. The company creates R&S to achieve specific future goals, such as purchasing fixed assets, paying dividends, repaying debt, legal settlements, and more. The company can use these reserves according to their nature or purpose. Reserves and surplus. Some of the most common types of reserves and surplus include general reserve. Also known as revenue reserve, it is the amount set aside by a company from its profits for future purposes. Capital reserve. This reserve is created when a company sells its fixed assets for more than their book value. Surplus. This is the amount remaining after a company has paid off all its liabilities. Net worth. It is the difference between a company's total assets and total liabilities. It is also known as book value or shareholders' equity. A company's net assets can be calculated using the following formula. Net worth is equal to total assets minus total liabilities. A company's net assets represent the amount remaining if the company sells all its assets and pays off all its liabilities. It is a measure of the company's financial health and stability. If a company's net worth is positive, it means the company has more assets than liabilities. Profit and loss details. It is also called the income statement. The profit and loss statement shows the operational results of a business for a specific period. It can be for a quarter, half year, or the entire year. Retained earnings and surplus. Retained earnings are any income or profit for the year that is not paid out to shareholders. If a company earns 1,000 rupees in profit and pays 0 dividends, its retained earnings will be 1,000 rupees. If the company earns 1,000 rupees in profit but decides to pay 200 rupees as dividends, the retained earnings for that year will be 800 rupees. This 800 rupee will go from the bottom of the P&L statement to the surplus under shareholders' equity on the balance sheet. Retained earnings continue to accumulate year after year under the surplus on the balance sheet. Inventory is the goods that are kept for sale or the items used to make a product that is later sold. Therefore, an organization keeps either raw materials or finished goods. Until these goods are sold and money is received from it, it is not added to the profit and loss record. In both cases, it will be recorded as inventory on the balance sheet. The value is recorded in the profit and loss statement only after the product is sold and revenue is generated. The more an organization sells, the higher the cost of goods sold will continue to rise. To prevent inventory from reducing on the balance sheet, the company continues to manufacture more of its products to ensure that products are available for sale. Costs are of two types. One is for creating assets, and the other is for regular expenses. If the benefit from an asset lasts more than 1 year, its cost is capitalized on the balance sheet. This includes items like PP&E, plant, property, and equipment. Capitalized assets affect the profit and loss (P&L) statement through amortization. Depreciation and amortization are two methods to measure the reduction in value of assets over time. Amortization means that a fixed portion of the cost of an asset will be expensed each year based on the expected future benefit from that asset. For example, if an asset has a 5-year life, 1/5 of its value will be expensed each year. Depreciation applies to tangible assets like machinery, buildings, while amortization applies to intangible assets like patents, trademarks. Both aim to show the decline in value of the asset during its useful life. An important part of expense is cost of goods sold. This is the expense incurred on the purchase of raw materials, product manufacturing, packaging, and transportation, etc. Another important part of the balance sheet is its expense, which is called Selling, General, and Administrative Expenses (SGA). This is a major non-production cost presented in the income statement, profit, or loss statement. SGA expenses include the following: selling, labor wages, advertising expenses, rent, and all costs and taxes related to selling the product. General, the general operations of the company. Administrative, executive salaries and overall administration of the company. Profit indicators in the P&L statement. Top line refers to the total earnings, revenue, of a company, that is, the total money a business has made during a specific period. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is a financial metric used to understand how well a company's core business is performing. While the top line shows the overall earnings, EBITDA indicates how profitable the company's core operations are. Bottom line refers to the net profit or loss after all expenses during a specific time period. It is the final line in the company's income statement and shows whether the company made a profit or incurred a loss. Thank you.